Joining us. Phil, welcome. Good to have you back. Let's begin with the move lower in the 2-year yesterday, responding to the resurfacing of bank concerns.
Yeah, that's it. I mean, it's just a lot of world of worry out there. A lot of concerns about, this recession.
Joining us. Phil, welcome. Good to have you back. Let's begin with the move lower in the 2-year yesterday, responding to the resurfacing of bank concerns.
Yeah, that's it. I mean, it's just a lot of world of worry out there. A lot of concerns about, this recession that's upcoming. You got softer jobs data coming out as well. Consumer confidence reaching a 9-month low. So people are starting to weigh in, focus on this recession that's starting to come up. I think that the 2 years starting to reflect it. You're seeing yields across the board starting to come off, bond prices, 10-year treasuries all starting to turn back out to the upside here. And, there's no telling if this banking crisis is behind us. It could be just one of the cracks here in the dam, and ultimately we could break here. So we're keeping an eye on all those other regional banks. It seems like it was about a 2-week ago story, but it's starting to resurface again.
Starting to resurface, and I was writing down some of the, bearish fundamentals that you were just pointing to there, and I think we got to the list where I was like G or F, G, all of the above, but one that you forgot, some of the regional data that we've seen recently. I mean, yesterday it was the Richmond Fed, but I mean, the numbers there have been suggesting a slowdown also.
Yeah, it's softening U.S. Industrial demand and everything else that's coming out. And that kind of put that risk off vibe. That's why we saw yesterday, you're mentioning like copper.
Yeah,
that's
back below $4.
Over.
Yeah.
You look at also like the Australian dollar, the Canadian dollar, all those commodity-based currencies are starting to come off the board. You got crude oil closing out that gap here. Essentially it did. And you got gold just hovering right around 2,000. So I think people, they're a bit nervous, it seems like, in the markets. They've got their foot kind of out the door and they're ready to run out if the house catches on fire.
I like that. We've got the Canadian dollar here, but also the mention of Australian dollar, as you pointed to. And we did see the inflation numbers there rising by 1.4% quarter over quarter. That was a little bit more than expected, but less than the 1.9% rise you saw in the fourth quarter of 2022. So we have seen a little bit of indication that inflationary pressures are easing, even though crude continues to hang out at these levels. And to your point, in terms of slowing economy and expectations, copper has come off. Let's talk a little bit about the Fed's next move, because there's, again, basically 75–80% chance we'll see a quarter-point hike next week. But I think the focus should be a little bit more towards May. Obviously, there's a lot of attention on that fine-tuning aspect as we near that terminal rate.
Yeah, they should raise one more time, but the focus is that if you rewind back to like December in 2018, they came out and they said they were going to raise 3 more times in 2019. They were going to raise 2 more. They ended up cutting 3 times. And I think that that's what we're going to start to see, like a similar price action as before. The S&P really sold off into it. It looks like the S&P is starting to roll over coming into this final, what we anticipate as a final Fed rate hike, and then ultimately we should start a new bull market as the Fed gets softer, more dovish, as the weaker data comes out. So something to keep an eye on is that gold went from about 1,300 on up to 2,000 in that 2019 during that rate cut cycle. So we really think that, if gold can hang on here right around this 2,000, we could see that next, we might sell off into that next Fed rate hike, but we think we'll capitulate, and that could be the starting point for another run up to about $2,500.
We're going to talk a little bit more about gold in the next segment. We're going to dive a bit deeper into some of what we've seen in terms of commodities, but I did want to take a quick look here as far as gold, because you mentioned the rally up that we've seen, and I thought it was significant, not only up and through the 2,000 level, but taking a look at the move throughout the month of March. Here it is, the 60-minute candles. You can see we're going from 18 to 2063. It stalled out a little bit here, but still holding its own. So you have to take out 1980. That's the lower extreme. That's right around, well, I guess the 50-day moving average is just below it, around 1940. But here you can see holding up near these highs. Let's talk about, Phil, it's not just the Fed to keep an eye on, right? We've got a busy couple weeks in terms of central bankers, decision policymakers ultimately we'll hear from. We've got the Bank of Japan, Ueda's first rate decision in terms of this week, Friday morning, into the open. We'll hear from them, the ECB next week as well. We also heard from, who was it, Riksbank, ultimately, Sweden, raising 50 basis points here. And in addition to the BOE the following week, I mean, lots for investors to focus on here, not just the fundamentals that we've already discussed, but also in terms of decisions to come as far as central banks.
Yeah, a lot of the central banks, like you mentioned, like Canada and Australia, it seems like those guys are not going to raise rates anymore. They've kind of given up on the inflation fight. I think the ECB still got another couple rate hikes ahead of themselves here. The U.S., we only have 1 to 2 more. And if you look at like Swiss, that's been one of the best performing currencies out there. That one has mirrored that price action in the gold market. So, if you're going to buy any of the currencies, I think the Swiss is the one you got to stick with. We still like the dollar against that previous low here. That it was about a March 2nd low we saw on the on the dollar index. So we think that the dollar could bounce from here as well.
Phil, talk to us a little bit about what we're seeing in terms of the curve. A lot of focus here into the end of the year. It's kind of shifted as the attention's being directed a little bit more towards that kind of coming back into line. Talk to us what's been playing out between the 210. We sort of lost sight of it.
Yeah, we're still, we've still got negative 50 as the 2s versus 10s. I mean, it's way off of those worst levels where, we were negative 93. I mean, that was crazy. But, we still anticipate that it should continue to tighten out. We think that they're going to try and the curve's ultimately going to start to flatten out again as you get closer to this recession gets baked in. So I think, the trade, I think right now is to still take advantage of these higher price levels on equities and get some puts going out to the farther end of the year to brace yourself for any kind of sell-off that we anticipate will happen, which will ultimately give you the next great buying opportunity.
Phil, lastly, I wanted to get your thoughts here, kind of tying into what we're seeing as far as the curve, rates recently coming off, and expectations as far as the Fed, the May, ultimately the June meeting, auctions this week. How much attention do you give demand for U.S. debt right now with all the other focal points, obviously earnings, eco data taking center stage here, but we've got the 2, the 5, the 7 this week as well, and I'm sort of wondering where that ties into everything as far as the bigger picture.
Everybody's trying to lock in these higher yields for their portfolios because, you come into a recession, you're going to see, people are going to be chasing it. It reminds me back like with the financial crisis, we saw CDs and 1 year treasuries were at like 5.5%, 6%. And then all of a sudden they cratered after that. So you definitely want to lock in some of these. We think that bonds have been a great buy. 10 years and all the short duration, treasuries have been a really good buy in portfolios, and that's kind of the spot you want to be a little bit more weighted on.
Yeah, an interesting dynamic yesterday with the indices falling, yet Treasury futures rallying, rates coming off. So maybe we'll start to see that play out a little bit more, a bit of a shift in terms of that today, right? We've got rates up and indices up. Well, 3 of the 4 majors at least. The Russell's still struggling. Phil, appreciate you joining us here to break it down, talking financial markets and a very busy couple weeks to come in terms of central bank activity headed our way